Hello and welcome to the 2024 quarter two review, where we'll take a look at what happened in the markets and I'll also give you a learning so you can take something away. So the lesson for this time I want you to learn is going to be volatility and to understand what is normal and what is not, what's cause for concern and what's just everyday life in the market. So first off, the markets have done well this first part of the year, better than actually we expected. A lot of that has been driven by something we call multiple expansion, but basically it's in the future, people are very optimistic about what certain companies will be able to do when it comes to profitability. What that means, though, is that as we've looked at before, we know that market shifts happen both up and down when expectation doesn't meet reality. If it's reality is better than the expectation, we'll see a jump upwards. If reality is worse than the expectation, then we'll see tend to see a pullback. We're in a point now where markets are pricing in pretty optimistically. Um, we've had a big rally when it comes to AI and what the potential could be in that space, and that is driving uh, lot of the gains that we've seen this year. But that means that I want you to be prepared and know what is normal if it doesn't go the way that people hoping it does. We do see a pullback. So we all often focus on what the return was for the year, and that paints a very pretty picture of the markets over the last 100 years, but think of the last 10 years. But I wanted to show you what the route that you had to go to get there. So here, this chart shows the intra-year declines. So from at certain points in the year, how much it pulled back versus in the gray here, what the year actually ended up. The end of the year performance that you will see in papers. So, what do we see? Well, we see, first of all, it's very common. In fact, it's more common than not to have pullbacks in the year. In fact, the average drawdown is around 10%. In a year where the market's dropped 10%, that is normal. What does that mean in real life? Well, think of a number that is meaningful to you to invest. I'm going to use $1 million. 10% on $1 million is $100,000. That means in a normal year, nothing to worry about, nothing to panic about, everything's as it should be, your portfolio would drop $100,000. $1 million portfolio down to $900,000. And there's more to it. So if we go back, we see this year here, this was minus 28%. That's $280,000 that $1 million portfolio would have dropped during the year, and it ended up $230,000. So that $1 million portfolio went down $280,000 and then ended the year worth $1.2 million. And we see the same thing over and over again. This year, this portfolio would have lost $160,000, ended up $130,000, would have been down $60,000, ended up $300,000 on the year. When we come back to more recent years, like COVID, that $1 million portfolio would have had to endure being down $340,000 only for it to end up worth $1.16 million. And we see the same thing over and over again. And there are years that you're rewarded for this volatility. For example, last year, it was down 10%. You ended up 24% if you stayed invested. Again, previous year, you didn't get rewarded. You just, as long as you didn't sell, you ended up only down 19%. That's $190,000 you ended up down on the year, and you would have been down throughout the year a total of $250,000. And we see this over and over again. So no matter what happens in this coming next 6 months, honestly, what happens in the next years, it's important to keep in mind that this is very normal, and it doesn't mean, depending on how you view risk, it doesn't make it risky. For example, if you quantify risk by risk of you losing your money so the money dropping and it not having the opportunity to come back up, then that is not the same way that the overall markets are not risky. Why? Because we've seen these drops are normal, they're to be expected, and at no point in history has the markets dropped and not come back up. So risk of that happening is very low. But if we're talking about the risk of having to endure downs, then the markets would be considered risky because you absolutely would have to endure downs. That is normal. A minus 10% drawdown in the markets, totally normal. A minus 20% drawdown in the markets, verging on abnormal, but common, unfortunately. Minus 50% drawdown like 2008, not normal. Yeah, I can expect a lot of panic if that happens. But again, we've been there, we've seen it, and certainly downs in the tens, in the low, like between 8 and 15%. You will not see me panicking. That's another day in the markets. Okay, now the important stuff's out of the way. What did the markets do over the last little while? While the Canadian market's down a little bit, the US market's up because of the reasons we just talked about. International Europe is flat. Emerging markets have done pretty well. Real estate is flat pretty much. Bonds. Okay, bonds have been talked about a lot over the last little while. The markets are expecting interest rates to stay higher for longer. There was a period of time when we expected interest rates to come all the way back down to, around that 3% mark. Now it's looking like it will settle around that 3.5% long term. Between that 3 and 4%, that is a good range for an economy. That's a healthy economy. And that's around where we would like to see debt be and interest rates be. What we saw prior to COVID with interest rates near zero, that was the abnormality. That is not normal. Between that 3 and 4%, that is normal. That would be a good place for it to settle. With inflation numbers coming down, there's a lot of positivity and a lot of hope that things will settle around that mark. So nothing to be concerned about there, in my opinion. Long-term returns of stock markets, as always, long-term is very green. Still way too risky to invest in the stock market if your time frame is only a year away. Who knows what can happen in a year? But the longer that you go out, as we've seen before, and I keep saying, it becomes less and less risky to invest in equity. In fact, the risk shifts towards it being the risky option is actually to invest in GICs and bonds when you're talking about a longer time frame. And you see that throughout history. If you're looking for most consistent way make good decisions, so it's just investing according to the time frame. That has not changed. That's been the way for many, many years and unlikely to change. Anyway, if you do have any questions, if you do have any concerns about how this could impact you, or if you want to review your portfolio, whatever it is, let me know. Feel free to reach out as always. And I will see you in the next one. Thank you.